Good afternoon, and thank you for joining us today. My name is David Talbot. I'm Managing Director and Head of Research here at Red Cloud Securities, and I'm delighted to host a Red Cloud webinar on uranium today. And we are joined by Anfield Energy CEO Corey Diaz today. Now, during the webinar, he will provide an overview and outlook, and then we will take some questions. So you can type your questions into the chat box at any time, and we'll get to as many as we can. But before we kick things off, first we need to discuss the fine print. During this Anfield webinar, forward-looking statements may be made. I would direct listeners to the forward-looking statements outlined on page 2 of Anfield's corporate presentation. That can be found on its website, anfieldenergy.com. For Red Cloud Securities, I'd highlight this webinar is for information purposes only. It should not be considered a solicitation or recommendation to buy or sell securities. We note this call does not consider the particular situation or needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investing. So please see our most recent research located on the Red Cloud website for specific disclosures on Anfield Energy. Now with that, I'm going to turn it over to Corey Diaz to update the audience on Anfield Energy. Corey.
All right. Thanks, David, and thanks everyone for joining. I'm here to discuss Anfield Energy. It's a uranium and vanadium company with all of its assets in the U.S., which has a plan for near-term production of uranium and vanadium through its hub-and-spoke strategy. Safe harbor, read at your leisure. The capital markets profile of the company, the ticker symbols AEC on the venture, on the QB ANLDF, market cap of roughly $67 million. Our largest shareholders are Encore Energy and Uranium Energy Corporation. Management insiders hold roughly 4 to 5% of the stock. Red Cloud provides research coverage through David Talbot with a 20-cent target price. Reasons to invest in Anfield. We have a large portfolio of conventional assets in the United States, underpinned by the Shootaring Canyon Mill, which is a 750-ton per day mill, one of only 3 licensed, permitted, constructed conventional uranium mills in the United States. Our assets are strategically located within one of the most prolific production areas in the U.S. On a historical basis. We have assets in Colorado, Utah, New Mexico, and Arizona. We have a mix of both historic resource, current resource, or historic production on the property. So we're not a greenfield company. We focus on brownfield. Our aim is to get assets which fit our near-term production profile under our portfolio. And to that vein, we actually acquired the Slick Rock project in Colorado from UEC back in 2022 in exchange for our ISR properties in Wyoming. And these assets fit well into our portfolio of conventional assets, which are underpinned by the mill. Finally, we acquired the Marquez 1-4 project in New Mexico from Encore earlier this year. That's our largest single uranium assets in our portfolio, about 18 million pounds of resource. It also serves as an entry point into New Mexico as a prospective market for us as we look to build up our secondary production plan. The macro view on uranium, I'm sure many of you are familiar with the geopolitical risks inherent in the sector. Obviously, what's taking place in Russia and Ukraine has affected the conversion and enrichment side of the business pretty significantly. Russia has a large percentage ownership of conversion and enrichment services, which has affected a lot of the US-based utilities who would depend on those services for material that comes out of Kazakhstan. Speaking of Kazakhstan, China and Kazakhstan have become much more close over the past few months. China has actually proposed a trading hub on the border of China and Kazakhstan, and Kazakhstan looks to be selling more material to China as China is building out its nuclear fleet very quickly. The coup in Niger disrupted France's Orano production. And obviously, the U.S. is getting involved now to help to mitigate any kind of issues that are in Niger to hopefully move that production forward again. But once again, these are the risks that you're facing when you're in countries which are less stable than North American or Western societies. Finally, in the U.S., has the largest nuclear power plant installed base, but however, domestic production of uranium is, at an all-time low, close to less than 1 million pounds a year. So the fact that the U.S. uses, between 45 million and 50 million pounds per year of uranium, and yet produces less than 1 million pounds a year, means that the dependence of the U.S. utilities on foreign suppliers is quite high, and clearly there's a risk associated with that. And so we believe that it makes sense for domestic supply to start to increase in order to meet some of the demand driven by the needs of U.S. utilities. Speaking of opportunities, China, UAE, India, Eastern Europe are all approving reactors. Japan is restarting reactors which were shut down post-Fukushima. They've also lifted the cap on the life extensions on a number of those reactors from 60 years to 80 years, which means, once again, more uranium will be required. There's a 200 gigawatt roadmap being put forth by the USA in order to expand mining and milling operations by over 100 million pounds per year of uranium, which means that there's going to be a significant uptick in the demand being driven by these types of initiatives. And then finally, earlier this year, the Uranium Reserve Program acquired 1 million pounds of uranium at an average price of $60 a pound. I think this is noteworthy because at the time, the spot price was about $50 a pound, so there's a premium paid in the U.S. for material. And I think going forward, there's likely to be a bifurcation of the market, between U.S. pricing and rest of world pricing, given the demand and the strong demand that's showing up domestically. But supply, as I mentioned, remains an issue. Cameco, one of the largest producers in the world, is selling to China Nuclear and Ukraine Energoatom, which is removing material from the North American market, which would be beneficial to U.S. utilities. Spot, Yellowcake, other physical uranium funds, which are popping up, are purchasing pounds of the spot market, which means there are fewer pounds for utilities to find in the near term. Kazatomprom is forecasted production slowdowns in 2023 and 2024, and has signed long-term contracts with China, as I mentioned earlier, which means that material is no longer going to flow west as it did in the past. And then an interesting data point related to South Korea, a few months ago, put out an RFP with a $58 floor and a $90 ceiling, and there were no bids, which I think points to the fact that everyone understands that the market is moving in one direction. Supply is tightening. So the only thing that can happen now is that prices start to move up in order to meet the needs of producers. So our hub and spoke opportunity that I mentioned earlier, it's driven by the Shootaring Canyon Mill. If you look at the picture to the top right, Shootaring Canyon Mill represented by the gray dot, and the Velvet Wood and Slick Rock properties, which are the darker blue dots. Those represent our current hub and spoke strategy. So the Shootaring Canyon Mill will receive uranium from both Velvet Wood and Slick Rock. This is shown in our NPV, our PEA that was put out earlier this year, which returned an NPV of $238 million using a uranium price of $70. Clearly, the economics will improve given where the uranium price is today, and we expect to be in production within 24 months. And at that time, we'd expect to see the uranium price probably in triple digits. So we also have other assets, the West Slope, Frank M, Finley Tank, which could be included as other spokes in our hub and spoke strategy, which would certainly obviously improve the economics related to our portfolio. So the core assets in our hub and spoke production strategy, as I mentioned, the pictures to the right represent the mill. There's a close-up shot and then a shot from a distance. Shootaring Canyon Mill, we acquired this back in 2015 from Uranium One of only 3 licensed, permitted, and constructed conventional uranium mills in existence in the U.S. We've got the Velvet Wood Mine, which we acquired alongside the mill from Uranium One, historic production of 4 million pounds of uranium, 5 million pounds of vanadium. We have a current resource of roughly 5 million pounds of uranium and 7 million pounds of vanadium at site. The PEA that we put out in early 2023 reflected positive economics related to Velvet Wood. West Slope we acquired from Cotter Corporation, which is owned by General Atomics, a weapons defense manufacturer out of San Diego, back in 2018. The West Slope properties include 9 separate mines. We did put out a resource on 4 of the 9 most prospective mines. The resource returned 5.4 million pounds of uranium, 27 million pounds of vanadium. We have historic resource in the remaining 5 of roughly 4 million pounds of uranium and 20 million pounds of vanadium. So those are very prospective and certainly could be added to our hub and spoke plan. But we're starting with Slick Rock and Velvet Wood. And speaking of Slick Rock, we have an inferred resource of roughly 8 million pounds of uranium and 47 million pounds of vanadium. This is the asset, as I mentioned earlier, we acquired through an asset swap with UEC. There was a PEA, as I mentioned, back in 2023, earlier this year, that includes Slick Rock, Velvet Wood, and Shootaring, and which provided positive economics related to Slick Rock. So secondary pipeline acquisition, as I mentioned, our near-term focus is on the hub and spoke assets that I'd mentioned earlier that are reflected in the PEA. The Marcus One Tafoya represents the key asset in our secondary production plan, 18 million pounds of resource, no vanadium there. There is a historic PAA on the property, roughly $21 million, using a $60 uranium price. Another data point is once the uranium price of $70 used in this PEA, the NPV bumps up to roughly $73 million. So there's clearly a highly leveraged opportunity here, to uranium, the uranium price when looking at Marcus One Tafoya. And so this is our largest single uranium resource. It's an advanced asset. Once again, we look for advanced assets. We don't look for greenfield assets. We look for assets which have past production or an existing resource or historic resource in place that we can advance relatively quickly and cheaply. And it serves as an anchor asset for our secondary production plan once we've exhausted our assets in Utah and Colorado. So Anfield steps to production. As I mentioned, the near-term production plan involves Shootaring, Velvet Wood, Slick Rock, and our hub and spoke. We're also working with a company called PSC, Precision Systems Engineering, to look at the possibility of increasing throughput capacity at the mill from 750 tons per day to 1,000 tons per day, and increasing our production capacity from its current 1 million pound license capacity to roughly 3 million pounds of license capacity. And we're also adding a vanadium circuit to the mill, which is not, the mill doesn't currently have one. But that's because most of the mines that we have, both Velvet Wood, Slick Rock, but also including West Slope, the Colorado-based mines are actually vanadium mines with uranium in them. So it's usually 1 part uranium to roughly 4 or 5 parts vanadium. So being able to capture the vanadium from these mines, it provides us with another opportunity to create a secondary business related to vanadium flow batteries, other vanadium-related businesses. So it's another significant opportunity for the company as we move forward. The midterm production plan relates to West Slope. As I mentioned, this consists of 9 mines. We put out resource on 4 with a plan to put economics to those 4 in 2024, and then put out a resource for the remaining 5 at some point in 2024, and look at what the economics could potentially be as we consider adding those to part of our hub and spoke plan. Then finally, as I mentioned, One Tafoya will be the key asset within our secondary production plan. It's a large single resource, but certainly we have other assets in Arizona and in Utah that we can include as part of the longer term plan. So we do have a plan to have roughly 20 to 25 million pounds to go through our mill in the relative near term. We'd expect to see a kind of a 20-year life of mining and milling within the portfolio. And our aim is to replace those pounds as we put pounds through the mill. So we always have, at least 20 million pounds available to us to put through the mill. We think it's important to note that we don't want to be in a position where we have a finite number of pounds. We want to continue to have resource available to us for the foreseeable future. Development Wood project. Just a few more details related to this asset. As I mentioned, we acquired this from Uranium One in 2015. Historic production at site, lots of infrastructure, paved roads, grid power, water, relatively close to the mill. There are existing declines. There's existing workings that we can actually access. So to get this up and running should be relatively straightforward. We expect to have this mine ready for production in roughly 18 months. We're working on a plan of operations at the moment. We'll be doing some additional drilling in order to make sure we've got the delineation available for our mine planning. And certainly we'll be ready ahead of the time that we'll have the mill up and running. West Slope project, as I mentioned, acquired from Cotter back in 2018, consisting of 9 DOE leases. There's historic production there, 1.3 million pounds of uranium, 6.6 million pounds of vanadium, most recently in 2006. You see the pictures to the right. Those are, the top one is of the adit at JD6. The bottom left is JD7, and another angle from JD7 in the third picture. There's historic adits in place. They're actually, there's ore right as you enter the adits. There's equipment inside. There's certainly road and power access. As I mentioned, we're looking to put a PEA out for some of the properties and putting resource out on the others. We're actually doing a drill program at site, probably late 2024 on some of these assets, the most prospective of those. But we're going to continue to keep these assets available for us to add to our production plan in the near term, because it'll be relatively cheap to get these up and running given their current state and given the equipment that's at site. And finally, Slick Rock project, acquired through an asset swap, and as I mentioned, with UEC. There's existing shafts and portals at site. We do have some West Slope properties which are very close to where Slick Rock sits. You can see Slick Rock is represented by the green shape. The top blue shape is actually one of our West Slope properties, so you can see how close these assets are to each other. And so there's the prospect of creating a mine plan which incorporates some of the other assets, not only Slick Rock, but also our other West Slope properties. We are actually looking to do a drill program. We've submitted an application to the BLM for drilling to start in the spring, a 20-hole program in order to help us delineate the resource and create a mine plan. And the aim is to have this available and ready in roughly 18 months. So we'll be ready ahead of the mill coming back online. So peer comparison. If you look at the list here, the companies, the 4 immediate companies to the right of AEC, so it's Energy Fuels, UEC, Encore, and Your Energy, all have production facilities, much like AEC does. However, the market caps related to those companies dwarf AEC significantly. The smallest of those companies, the smallest one is roughly 7 to 8 times the size of Anfield. That's Your Energy. So more than $500 million market cap. And Anfield is less than 100 million. The resource is relatively similar to Your Energy. Certainly, Anfield has a significant vanadium endowment, much larger than anyone else on this list. The companies, the last 3 companies on the list, Peninsula, Laramide, and Western, none has a producing facility, although Peninsula is spending money now to build its own facility. Laramide and Western do not, but yet market caps are larger than or higher than AEC's, which we don't believe there's a justification for. But certainly we think that we should see our valuation tick up as we continue to advance our assets and put ourselves in a position to produce. Obviously, the cost to build a new plant is quite high. So given that we do have an existing facility that we just need to refurbish, I think that we should be getting a bit more of a benefit from acknowledgement in the marketplace for having that asset and this asset base that we believe isn't reflected in the share price. So management directors, I'll just point out a few of the directors and their importance. Ken Mashinsky, over 30 years in nuclear-related experience at General Atomics. He was the president of Cotter when we acquired the Westlow properties. He has run a producing uranium company, Quasar Resources. He was the president of that company, which produced 5 million pounds per year of uranium. He's done government lobbying in order to secure business through the government related to uranium. He has actually sat on the management committee of ConverDyn, which is the conversion business. He has done sales and marketing for uranium. So he ticks a lot of the boxes when it comes to our requirements as we move forward towards production. Josh Bleak, another co-founder of the company. He's been in mining for over 20 years. He's the fourth generation of miners within his family. He's our man on the ground in the U.S. He's got a lot of family that's worked in uranium over the years. He's helped us identify assets that we brought into the company. And so, he's a very important piece of the puzzle. We also have Don Falconer, who is someone who has actually worked in uranium for many, many years, 35 years of uranium and nuclear-related experience. He worked for Ontario Power Generation in the nuclear division, doing sales and marketing. He sat on the board of Energy Fuels. He's run publicly traded uranium companies. And so he's very familiar with the landscape too. And then a little bit on the other assets that we didn't touch on earlier, Frank M, Finley Tank. Frank M is a lower grade uranium deposit near the mill, which we could potentially use as mix to downgrade some of the resource if it's too rich coming into the site. Finley Tank, that's in northern Arizona. Those are assets which tend to be pressure pipe projects, which are vertical resources versus horizontal resources. Not something that we're interested in exploiting in the near term, but certainly these are assets that are within the portfolio, and they came with both Shootaring and Velvet Wood when we acquired assets from Uranium Lawn back in 2015. And that's the story. At the end of the day, Anfield's in a great position to begin producing uranium within 24 months. We're refurbishing the mill at the moment. We're advancing our mines that will go through the mill. We have a plan, hub and spoke strategy underpinned by the mill, and we have additional resource that can help to string out production for a significant number of years.
Okay, thank you very much, Corey. Great presentation. We are now going to start the Q&A portion of the webinar. Reminder to everybody online that you can type your questions into the chat box at any time. We already have a couple questions. So, Corey, your Shootaring Canyon Mill does need refurbishment here. How much do you anticipate that to cost, and what still needs to be done? Sure, that's a great question. So the mill itself will cost roughly $30 to $35 million. We also have to refurb the tailings pond, or rebuild the tailings pond, because it needs to be reflective of best available technology today. That will cost somewhere between $10 and $20 million, depending on the approach we take. And then finally, we are adding that new circuit to the mill, which is a $15 to $20 million undertaking. But I think it's important to recognize that we have over 100 million pounds of vanadium available to us. And so that makes a lot of sense in terms of economics to add that circuit to the mill. So there's certain money that needs to be spent in order to refurbish the mill, but I think it's important to note the cost to build a new mill would be over $200 million of a similar size. Yeah, and the mill is already permitted, but is there any additional amendments or permits that you need to do in order to upgrade the mill? Do you need it to increase production capacity to, say, 1,000 tons per day, or increase the license from 1 million to 3 million, as you so suggested?
No, so our application for the restart of the mill, which will be submitted in early 2024, will incorporate everything that I discussed today. So the state's very keen to get this mill up and running. And so part of the process, working with the state's job is to make sure that emissions, we don't affect kind of water or air quality. And so as long as we can meet the standards set by the state in terms of not exceeding water and air quality limits, there's no issue for us to get our license moved from its current status to operation. So, the state is happy to work with us. There's nothing else that we need to do outside of submit, our plans for the mill, which includes the increase in terms of the throughput and the increase in terms of license capacity. As long as those limits don't affect water and air quality, we're fine. And we're very aware that there are other parties who have similar size or larger size mills, whose output doesn't affect water or air quality. So we're not concerned at all.
Is the tailings upgrade something you have to do right away?
The tailings we'll have to do in conjunction with, and it's part of the same license. So we can, once we've submitted the license, we believe we'll be in a position to actually start work on the tailings. So as we're going through the process of requests for more information from the state through that 12-month process, we'll start work on fixing whatever issues there are at the tailings pond. But it's going to be done all in conjunction with the work done at the mill.
Mm-hmm. Okay, and for your hub and spoke model, do you have what you need right now? I think you mentioned you want to have a pipeline of about 20 million pounds in resource available at any given time.
Well, we have about 47 million pounds today. So, we're well endowed with pounds to go through the mill. Our plan, the way that the mill works right now, and our PEA talks about using both slick rock and velvet wood. We're probably going to look to pull out, kind of 500 tons per day from, up to 500 tons per day from slick rock through two different areas, mining from two different areas, and then velvet wood about 750. Velvet wood will probably run off by the end of year 8. And then we've got a space there because slick rock will run for 16 years, roughly, in our current model. And so we can plug in West Slope, after year 8, where velvet wood was. But if we increase the throughput, we can actually add West Slope in even earlier at the beginning. So we can have 2 points or more points at slick rock. We can add in 1 or 2 mines at West Slope, and then add in velvet wood. So we've got a number of different ways to skin a cat here, but that's why we want to make sure that we can get as many pounds in and have as much runway as possible in the same area in order to kind of sustain production over 20 years.
Right, and I guess you probably won't stop looking for assets or being opportunistic. So when you look for potential projects, how do you decide looking for something for long-term growth versus something that might be more immediate and fill your mill?
I think there's, we obviously look at the idea of our pounds, first of all, how big are they? How accessible are they? Have they been recently mined, or have they been mined in the past? We have to understand the economics of them, but also proximity matters too. We've managed to secure a number of assets within the Colorado Plateau. We think there's a lot of prospective assets in the area, and we've kicked tires on a number of different things in the area over the years. And so, the more advanced they are, the more attractive they are to us if they're near-term assets. If we're looking outside of that area in New Mexico, Arizona, we have to understand, those may not come online for 10 years, but it provides us the opportunity to spend time to advance those. If we have to work with the NRC in order to get certain permits and licenses in order to advance those, we have the time. So it provides us with, near-term easier access versus longer-term more work to be put in, to complement what we have in the near term. So we do look at not only location, but also how easy it is to advance it, and kind of what the risk reward would be in terms of the size of asset versus time frame.
And I imagine if you're looking at location, you're also looking at uranium versus vanadium as well.
Absolutely. Vanadium is something that we think is very attractive, especially when you're looking at shipping costs from a place like Colorado to the mill. A lot easier to ship things when you've got significant vanadium included. In many ways, that can cover the cost of the travel, and you can get the full upside of the price of uranium. So, we certainly think those assets. We're very excited about assets which do have kind of that duality, the opportunity for vanadium and uranium. So that's also something you consider.
Yeah. So are your New Mexico assets close enough to ship to the mill in Utah?
They will be. I mean, there's certainly ways to upgrade at site underground that we'll consider. And once again, we've bought ourselves time because we have such a large near-term portfolio that we can look for ways to make those pounds economic relatively easy over a period of time. So if it were our flagship asset that we had to get to production tomorrow, that would be a bit more challenging. But because we've got the time and we'll have production in place, and the cost to do the work at the site won't be funded by investors, hopefully funded by internal cash flow, it makes it a little bit easier for us to push that forward.
Okay, you did mention flagship asset, and Slick Rock. I'm not sure if that's flagship or just coming first, but is there potential to increase resources beyond the 8 million pounds of uranium, 47 million pounds of vanadium at that site?
There is. There are other perspectives, hot zones, I guess you'd say, on the property that haven't been fully exploited. That's something that we're going to look to do. Once we get our current pounds under pattern, we'll look for expansion potential. Once again, because we've got Velvet Wood, we've got West Slope, it buys us that opportunity to, start production and then expand without, concern about, this is our one and only asset that needs to provide all the pounds that we require. So the flexibility that we've got inherent in these assets is very important.
Okay. Sounds like 2024 is going to be all about resource estimates and economic studies. So when might you consider moving something towards production?
So we are doing, the aim for next year is to start the process of getting Slick Rock and Velvet Wood into production status. And that'll take about 18 months for each of those. We will be submitting our plans to the state for restart in early 2024, and that prospect will take roughly 12 months. I think within that 12 months, we'll be able to do a little bit of work at the mill, some demolition work for the old CCD circuit, which is no longer there, some work at the tailings pond, and buying equipment that we can kind of lay on its side at site in anticipation of the license approval taking place. So there'll certainly be some activity at the site, the mill site, and the mine sites.
Okay. And in order to help you get to production, do you really need to fill out your management team here, maybe seek some mining engineers or chief operating officer?
Yeah, so we've got, it's like you're reading my mind. We've got, we do have a few people in mind. We do have a plan for next year, which will include staffing up in a number of different areas. And we've been in touch with a fair number of people over the last, 6 to 12 months. And it's all down to timing. We don't want to bring anyone on too early. We want to be in a position where, the requirement is there, or we're anticipating the requirement to be there. So, we've certainly got our finger on the pulse as to who we need to bring on.
Mm-hmm. And the mill itself is somewhat remote as well. So how do you staff up that and retain the workforce there?
Sure. When there was staff there, when Uranium One had the mill back in the early 2000s or mid 2000s, there's a small town called TSX-V, which is very close to the mill, about a 15-minute drive or less, where people would stay. There's also Hanksville, which is about 50 miles away, about an hour drive. And there's certainly our mine manager lives there now. So there are people who live and drive a fair distance to get to work, and are happy to do it. So there's certainly some flexibility, and obviously you have to make it appealing for somebody to want to live there, and so that's, there may be that premium for being a bit more remote. So we're aware of, what the costs could potentially be, but we certainly know that there are people who are interested in the work, especially a long-term opportunity of working at the mill or the mines.
Okay. Now, knowing you did divest of your Wyoming ISR assets, would you consider looking at ISR assets in either New Mexico or Texas, or do you think you'll keep it conventional?
I think we're we're very opportunistic. So if we see an asset of value, ISR or conventional, we'll certainly, look to acquire it. Whether that stays in our portfolio long term is another question. It could provide us another swap opportunity, provide us an opportunity to monetize, for a gain in some way that, puts us in a different strategic position. We're acquisition agnostic, I guess we'd say, but certainly there would be strategic use in us picking up other assets that we think could advance our portfolio. That's something that we would certainly consider.
Okay. I'm going to read this one verbatim here. I realize you're a mining company, but the key to Canada-U.S. uranium production is fabrication of fuel rods, etc. So one, can you comment on measures taken to increase fabrication in North America? And two, at this point in time, how do you plan to get your uranium fabricated?
Well, look, thank you for the question. I think it's important, given the geopolitical concerns worldwide, there's been a lot of eyeballs, a lot of thought, a lot of consideration given to all aspects of production, not just uranium. Because the way the path works is that you go from uranium to conversion to enrichment, and then enrichment to fabrication, which then the fabricated material pellets go into the rods that go into the reactor. So we're very much on one end of that chain. And so from our perspective, our job is to get uranium into the hands of utilities who then pass it on to converters and those who convert. So we're not involved in fabrication at all, but certainly I think it's important that all aspects have capacity available for the ultimate, creation of pellets that go into reactors, because that's what, will drive energy within a nuclear reactor. So, much like there are concerns around capacity of conversion and enrichment, there's likely the same on the fabrication side. So, so Cameco does everything soup to nuts. They have fabrication services within North America. So they're, I could see someone like Cameco looking in anticipation of, the groundswell of greater uranium production, to know that fabrication will obviously need to increase in order to meet, future demand. So I think all of the parties who work in each of these different segments are looking at ways to expand capacity. And so I think it's going to take time. I don't know if the nuclear industry hasn't really been as quick moving as, one would like, but I think they acknowledge and recognize now that, there's a lot of work that's required. And so they're trying to meet the moment and trying to create that capacity for that future demand. So I'm confident that it'll happen. Things don't happen overnight in nuclear, but I certainly do think that they are committing to increasing capacity for the requirements going forward.
Yeah, no, I think fabrication might have been used in general description of front-end processing of the fuel cycle there. But, I think fabrication of fuel rods per se is really the issue in North America. It's really mining. That is important. It's a little bit conversion to UF6, a large part enrichment, which is, 40% done by the Russians. And that's really the key, getting the UF6, the uranium in the UF6 from 0.7% U-235 to about 3.5 to 5% for most reactors in the world. So the fuel rod and fuel fabrication is probably less of an issue. Cameco and others do that in North America. I know the U.S. government's throwing money at the front end of the fuel cycle. They're looking at different ways to enrich as well. And as you said, Corey, no uranium companies really worry about fabrication or any other downstream blending. That's all up to the nuclear utility.
Right.
Yeah. Good. Maybe just last question here. Speaking of nuclear utilities, have you been approached by any of the U.S. nuclear utilities seeking long-term uranium supplies? Contracts, offtakes, that sort of thing.
Well, we have been. From our perspective, we're relatively small. We'll have up to 3 million pounds of production per year. I don't think it's, from our perspective, we don't necessarily need to have a contract in place today because we're seeing where the market's moving. We'll have funds in place or access to funds in order to do the work we need to for refurbishment of the mill and work for tailings and for the vanadium circuit. In the past, when the price was a little bit lower, signing a long-term contract allowed you to get those funds from lenders to say, look, we're able to sustain ourselves through a contract. But I think those days are gone. I think the market is moving in a way that funds will be available in the relative near term for the reasons we require it. I think another important thing is there was the was put out by South Korea a few months ago with a floor of $58 and a ceiling of $90, which went no bid. I think that speaks to where the market is today. There's not enough supply, and there's plenty of demand and growing demand. So there's no need to lock yourself into a contract that will be detrimental, to your prospects. And so, we're just not at the point now where we see a need to lock ourselves in. We think there'll be plenty of opportunities and plenty of buyers if we do decide to lock ourselves in. And maybe when we do lock ourselves in, it'll be a market-based contract. So it won't necessarily be, with floors and ceilings. It'll just be, this is where the market is, and we're happy to provide you with uranium. But we're not in any rush to lock ourselves in.
Right. To help alleviate some of that dilution you need in order to refurbish the plant and start up your mine sites, do you think it would be possible to arrange upfront payments associated with offtake?
Probably there'll be some of that, but there are also DOE is also providing funds. To your point, IRA. There are funds. The DOE is providing funds for mining. The DOE is providing funds for processing. And so we're in discussions with those parties. Whether those pan out, not sure. I mean, we're certainly cautiously optimistic that we can get some funding there, which would be long-term, low interest rate, funding, which would be ideal. On the DOED side, there's talk of grants. So as opposed to loans, so you're getting not free money, but certainly payment in advance for moving assets forward. So there's certainly money out there, not just private money, but also public money that we'll look to reach if we can. But certainly, even under a scenario where we have to go the private route and find funds to refurbish the mill and sort out the vanadium circuit, we'll be looking at some kind of ratio of probably 70% debt, 30% equity. So it won't be completely dilutive to the investors.
Great. Okay. Well, why don't we wrap it up there? Great conversation today. I think we covered a lot of ground there, Corey. So thank you very much for joining us.
All right. Thanks for your time, and thanks everyone for joining us.
Yeah, absolutely. Thank you everybody for listening in. Red Cloud Securities will be back tomorrow afternoon when Tim Lee sits down with Murchison Minerals. That's December 6th at 2 p.m. Eastern. So have a great day, everyone. Thank you very much.